Hi everyone, 12th of August 2017. This week the market had a very big down week and in a sense gave up the gains of the last 4 weeks all at one go. A large part of which came in the last 2 days on the back of a lot of geopolitical news. However, the trend had started earlier on, and therefore I think the news itself was essentially just aiding the trend. The market has peaked on the 2nd of August and had been already making lower tops since then, and had given up quite a bit from the highs. The momentum was already lost in a lot of stocks. So we were looking for a breakdown, but what you really don't like is if it's related to things like the potential of war. But having said that, the our own market's long-term wave count, in my reading, is that of doing a wave C on the downside, and that's very similar to what you would expect in maybe even Europe or some of the other markets around the world. And in that sense, heightened geopolitical risks are essentially part of the socioeconomic expectation in this part of the wave structure, but it's coming really early on, right at the start. And so my thought, the market should continue doing what it has to do for its own reasons, and the other external factors may just be part of the trend that is now started to develop. And in fact, I wanted to do this video right after the RBI meet, because what we saw was a rate cut, and a small one at that, and then a pause again to wait for more data. And my view on the video that I did just prior to that week was that if they do a rate cut, which was among all expectations, bond yields would still not go down in terms of the market rate, the traded rate. And that's exactly what happened on the RBI meet day, where the bond yields essentially did not go down, and they in fact bounced right back up after the announcement was made and have been ticking higher over the last 10 days. Even though the tick ups have been just 1 basis point, not meaningfully significant, but they have been going on, and that's what we've seen around the world. You had a spike up in bond yields everywhere when US bond yields moved up, and then they've been pulling back ever since. So we're essentially waiting for a sign of what I've been saying for quite a while, that the third wave has started down for bonds, which means yields start going up. We just got the initial push and then it's pulling back. We haven't had a very big move in the bond market, but I think it's more than due any time. And so you need to keep an eye on that, because the same thing happened exactly a year back. Starting from July all the way into December, you had US bonds falling and bond yields jumped. You did not see an impact of that on our own market, but some markets did feel it. But our own market did sell off after September, whether you relate it to the bond market or not. The only reason we didn't see a jump in yields and other effects of rising interest rates was that we did demonetization, which essentially put a lot of liquidity in the hands of the banks that had to be invested into the bond market, driving down bond yields in our own. So, in a way, you may say that demonetization was essentially fending off the global bond yield spike that we had last year. And once that was complete, our market took off again from there. And the expectation that has started building up, essentially because of the deflationary pressures we are seeing in the inflation side, is that rates will continue to get cut. However, what bond markets are indicating is that possibly bond yields will actually go higher. And so this debate goes on. Just yesterday you had data coming out of the US, which was indicating that inflation there too is not spiking, and probably they could hold back on further rate hikes. And so that again is building expectations of rates remaining flat or low, and that's continuing to drive down the dollar. But the very side effect of that is that the falling dollar is driving up the prices of commodities over the last 1 year. Even though precious metals haven't moved up that much, you've seen things like aluminum, zinc, most of the base metals spike up. Some of the agro commodity prices did move up but have pulled back. So we haven't seen big moves, but we have seen moves on the back of that. And once the dollar gets into the next phase, and the thing is, people still don't believe in the big macro trend, that is, the dollar has entered a bear market, which is something I've spoken on several videos and podcasts since January. Since it was 104 and now you're down to 92, people are still saying, oh, well, it might just be a bigger correction and the next bull run in the dollar will start. And my sense is you're already in a bear market for the dollar. So that's my contrarian stance. It's been right so far and expect that to continue. And the only side effect of that, which we've not seen, is we initially did get a jump up in inflation readings around the world into May, and then they've all started cooling off from there. And if the dollar keeps falling and you keep getting commodity price advances, then you could get another spike in inflation as well. But that remains an open case. In either case, you are in a dollar bear market, and its most direct impact is especially on US dollar denominated assets, equities, bonds, real estate, and so on. So that I spoke in my last video. So what I want to really focus on further again is that our own market got the heat essentially from it was stretching on a very narrow list of stocks. You If you look at many of the ones that I've written about over the last 2 months, they just did not make new highs. Whether it was the pharma sector, whether it was realty stocks like DLF, which peaked in May, and so did most of the PSU banks. You had the market running up on the back of mostly Reliance, Kotak, HDFC, the key drivers that have been so far, but it just got even narrower. And just like in 2015, 2016, when I do that quarterly review of 200 stocks, you had a 1 quarter down reading, which means the number of stocks above the 200 DMA actually declined because a larger number of stocks were losing momentum into the June quarter compared to March, even as the Nifty was making higher highs. So you had a lot of extreme sentiment readings, some of which I'll again cover in a separate note. But essentially, last month I wrote my long short report in July after a long lag from May. I didn't write anything in June because the market was stretching, even though you had all these extreme readings of sentiment and market expectations that you'll continue to run away to 10,000. But the sentiment was essentially showing that you were out of whack. One number that has floated around a lot, 10,350, and I wrote about that in January, though it was not my expectation. What I did mention is that if you do get an A equal to C log scale direction, then that number comes to 10,350. But my sense was that the rally that you'd got from 7,900 would probably not go beyond 8,900 was my original expectation. Once you got past that, while I've raised levels, I've mostly been looking after 9,200, 9,400 for a fifth wave to end. And that fifth wave stretched to 97, 98, 99, and now we've seen 10, 160. And last month I wrote what the big picture would be, in which the 138% point, the maximum extreme, which again I was saying you have two extremes when you consider that the entire move up from 2016 is a bear market rally, which is I think my standout view, because everybody else thinks this is a bull market that's going to just keep on going. And my sense is that's likely not the case, and you're still in the midst of an economic winter as you look at not just the weak economic data, part of which was out today. I mean, the economic survey is pointing to again weakness, and the government is finally talking about doing some kind of stimulus, whether it's monetary or otherwise. And the hard part is that they are not able to do so because a lot of their spending has gone in many other fronts. They have been spending some money to keep the economy growing, but the growth rates are far below what you would expect, and the headline numbers do not match what you see in terms of IIP, credit growth, and so on. And so there's a lot of the number playing is happening because of the way you measure inflation, and you do the value addition to the GDP based on the new methodology. So they're accepting the fact that things are slow and something needs to be done, but since you're spending so much on, you've had to actually see a reduction. I mean, there was a cost to demonetization. That's yesterday's news. You've put out money for the pay commission, you put out money to farm loan waivers, and so there is a limit to how much the government can keep spending, and therefore the room for stimulus is essentially limited. And then there's all the financing and funding that you have to do for the banks themselves, which is another problem in itself. So my view on the winter cycle remains the same. You have one major phase left in which you'd see the financial sector go through its a most difficult phase, and which would finally, at the end of which then you could actually start looking for the next bull market. So last month's long short report focused on the big picture wave counts, which I think are only starting to play out now this month. So even last month, the two levels were 9,700 and 9,990, 123%, 138% of AVA, and you went beyond 9,990, not significantly, so it doesn't really violate anything. It's just a expected range within which you expect a B wave of and expanded flat to really end. And so my sense is you most probably started a C wave down, and C wave is where you get the geopolitical issues mostly, and which is why it's not surprising that that's what you're getting. Many markets around the world would be in that kind of structure. And so on Monday, I plan to write another long short report focusing more on the immediate trends that are developing after this week's sell off, which was a faster, give up of the previous rise, which many take as a reading or a confirmation of a reversal. Weekly momentum indicators, of course, had negative divergences, but the RSI itself did not develop a negative divergence. It spiked to its highest level and gave up from there, which is interesting because I had this theory that trends actually reverse in the direction of the they actually develop divergences in the direction of the main trend, not in the counter trend. So not having divergences essentially is a sign of course this is not a rule, that this B wave occurred and is probably completing without a divergence, only confirms to the point that it's a part of a larger corrective phase, and which is why the number of stocks participating keep going down. But once you start wave C down, you essentially get a very broad-based decline, and all sectors and stocks get affected. And we saw the first signature of that this week. So, like I said, I'll cover that in detail on Monday itself. The consensus positioning, however, of the market participants is that you'll get a correction and then it's going to go back to new highs, which essentially has not been my opinion. I think every time I've expected a correction and I've looked for a bounce, the bounce has gone back to a new high, both at the smaller degree and at the larger degree, which means that even I can go all the way back to 2013. I did think the market bottomed at 5100 and I called for 6100. We were there within weeks. But I wasn't looking meaningfully beyond that, and we stayed there for a couple of months before breaking out higher. And then the same thing in 2015, after calling the top, once you crash to 6825, I called a move up back to 79 or 8200, and we ended up at 89. And then in 2016 December, again at 7900, I did think we'd go back to 8900, and we've gone past 9000 to 10,000 as well. So same thing at lower degrees, as we've been looking for a top for the last couple of months. We've still made higher highs, but lots of divergences, multiple extreme readings on put call ratios, on the breadth. The AD ratio has three major divergences month after month, and volatility at the lowest level and staying down there. So when you look at it historically, yes, volatility does fall and then spike back up. You get a near-term correction, and then the market may do whatever it wants to do, including going to a higher level. But in this particular period, we saw volatility remain low for a prolonged period of time, and I'm seeing that in multiple indicators that I track in terms of positions, long, shorts, and so on, that everything remained in an extreme situation for a longer period than we've ever seen in previous readings. I mean, typically earlier you got such a reading, if not in a month, next month you got a 7-8% correction. That was 2015. In 2016, you at least got a 4-5% correction, and this time around, you're not even getting a 2% pullback in Nifty till just now. So, which is why I think it's meaningful. And of course, the divergence in mid caps makes it also meaningful, because over the last 2 months, the mid cap indices stopped outperforming the large cap indices, and that's usually a lead indicator of a weakening market. And now that turn has occurred, my sense is that the trend should have possibly changed, and geopolitics might just be one of the things aiding that trend rather than going against it. And there's absolutely no improvement on the economic side. Hopes that things will pick up on the next quarter or quarter after that, and essentially most of these expectations come from the sell side of research, a lot, or rather a lot of it from the mutual fund side, which are actively on media. That's been one of the hottest sectors, and sometimes I actually sense that this time around the extreme sentiment has, in terms of participation of retail, has not happened in direct equity, and I think it's not just sense; it's actually out there in data, and it's actually happened through the fund route, portfolio management services, and mutual funds, which are long only. Have essentially attracted the largest amount of capital they have done ever in years, and that has become where the big sentiment play in terms of participation by the masses has taken place, driving up valuations to levels which everybody accepts is high, but nobody really knows when the liquidity pauses, and which is why nobody really likes to take a call on the contrarian side. But that's general market. Nobody likes to take a contra view simply because nobody wants to be wrong. And the whole object of wanting to appear right all the time keeps you from giving the right opinion to the public at large. And my sense, I mean, I really don't bother about those things. My view is that, market may be going higher because of flows, but essentially this is, in my view, part of a larger corrective phase. We're at the end of a major wave in the mid caps, which has been a 2 year long ending structure, and the end of an expanded flat B wave for the key large cap indices. And essentially, the next major phase of the winter cycle down is still pending. And only once that is complete, that I think you can have what you would call a long term bull market. And my meaning of long term is, when it runs into multiple years. I don't think you're at the start of a bull market, which is a runaway market, as many people would like you to believe. And that's despite that, there are stocks and sectors that have done well, mainly on the back of major outperformance of the mid cap sector. I mean, the only difference in the way I have approached this is that it's not that I have not written about, stocks. I have a segment which says value wave stocks, which where we cover bottom up trends based on the elite wave structure, and where they have positioned and where the risk is really low. And I started doing that right after I started India Charts Insiders in 2013. We covered the OMCs, then later these sugar stocks, the rice processors, and so on. So it's the question is not that. I mean, that's been one major factor, and I think everyone who's been bottom up have all become stars of this particular period. The only difference in my approaches has been I'm really not calling this a runaway bull market. Yes, you have stocks that could do well, that were undervalued, that have got the market's attention. And the reason they got that is because in the winter cycle you have debt related problems. Every company that was high on debts actually collapsed, starting from 2010, when I first wrote my economic winter cycle report. And money then moved away from that into stocks that did not have those problems, and essentially other themes. So it was a thematic market. Everybody's had their own theme, and everybody's been right on their own theme. So this is a point where everybody can claim credit for stocks that they've probably picked out. The thing that nobody's willing to say, and I'm probably being very clear and loud about it, irrespective, and you'll know later what's right or not, is that this is not sustainable. You cannot have a market that's purely run on a narrow list of stocks, or thematic does not go on forever. And you have to have a broad-based economic participation. And if so many large cap stocks are really not making 52-week highs with the Nifty, you should know that something's not right in the market internals, and you need to be aware of that, and not to know that eventually things don't end well in that scenario. So to expect that things will just keep running up and you'll go to 12,000, 13,000, or 15,000 Nifty, well, congratulations to all those people making those forecasts. I don't mind saying that right now. I don't want to be in that camp till I get more clear evidence of it happening. And for the time being, my view remains contrarian. So look forward to the long short report on Monday. This has been a long recording, and I hope you enjoy it and continue to read my work at India Charts and India Charts Insiders. Thank you for listening. Bye. Enjoy your weekend.